The debt ceiling is the maximum amount the U.S. government can borrow to meet its financial obligations. If lawmakers fail to raise it, the U.S. could default on its debt and trigger a financial crisis. But what does that mean and why does it matter? The debt ceiling was first introduced in 1917 as a way to simplify the borrowing process for the government during World War I. Since then, Congress has raised or suspended the debt limit 78 times to allow the government to keep borrowing and spending. The debt limit is not a limit on new spending, but on the existing legal obligations of the government, such as Social Security and Medicare benefits, military salaries, interest on the national debt, tax refunds and other payments. When the government spends more than it collects in taxes, it runs a deficit. To cover the gap, it borrows money by issuing bonds. The total amount of money the government owes to its creditors is the national debt. The U.S. debt ceiling was last raised in 2021 to $31.4 trillion, where it currently stands. However, the government has already reached that limit and is now relying on accounting tricks, known as extraordinary measures, to avoid defaulting on its obligations. These measures can only buy some time until the Treasury Department runs out of cash and borrowing authority. Treasury Secretary Janet Yellen has warned that this could happen as soon as June 1st. If Congress does not act by then, the U.S. would face an unprecedented situation of being unable to pay its bills in full and on time. This could have serious consequences for the economy and the financial markets. A default could cause interest rates to spike, stock prices to plummet, consumer confidence to drop, business activity to slow down and unemployment to rise. It could also damage the U.S. credit rating and reputation as a safe haven for investors. A debt ceiling crisis would also hit the housing market like a hurricane, according to Forbes. A default could disrupt mortgage lending, reduce home sales, lower home prices and increase foreclosures. In short, failing to raise the debt ceiling would be a self-inflicted wound that could plunge the U.S. into a recession or worse. That's why CFOs are preparing for a potential debt ceiling crisis by closely monitoring their cash flow, liquidity, and risk exposure. They are also looking for ways to diversify their funding sources, hedge their interest rate risk and protect their credit ratings. As the deadline looms, CFOs are hoping that Congress will act responsibly and raise the debt ceiling before it's too late. The debt ceiling is the legal limit on how much the U.S. government can borrow to fund its operations and pay its obligations. If Congress does not raise the debt ceiling by October 18, the Treasury Department will run out of cash and face the risk of defaulting on its debt. This could have severe consequences for the economy, the financial markets, and the credit rating of the U.S. How are CFOs preparing for this potential crisis? According to a recent survey by Deloitte, CFOs are taking several steps to mitigate the impact of a debt ceiling impasse. These include scenario planning. CFOs are developing contingency plans for different scenarios, such as a short-term delay, a partial shutdown, or a full-blown default. They are assessing how these scenarios could affect their revenues, costs, liquidity, supply chains, and customer demand. Increasing cash reserves. CFOs are building up their cash buffers to cope with potential disruptions in cash flow and credit availability. They are also reviewing their cash management policies and practices to optimize their cash position and reduce their reliance on external financing. Diversifying funding sources. CFOs are exploring alternative sources of funding, such as asset-based lending, private equity, or capital markets. They are also diversifying their funding mix and maturity profile to reduce their exposure to short-term debt and interest rate volatility. Monitoring market signals. CFOs are closely watching the market indicators that could signal a worsening of the debt ceiling situation, such as treasury yields, credit spreads, stock prices, and consumer confidence. They are also tracking the actions and statements of policymakers and rating agencies to anticipate any changes in the outlook or policy response. By taking these proactive measures, CFOs are preparing for a potential debt ceiling crisis and protecting their businesses from its adverse effects. However, they also hope that Congress will act swiftly and responsibly to raise the debt ceiling and avoid a default that could damage the economy and the reputation of the U.S.